My name is Joel Weber. I'm the editor of Bloomberg Markets. Really excited to be here with Adil Abdulali from Move37 and Carolyn Sherman, who's the Vice President of Product Strategy at Quantopian. So one of the things I just kind of want to start on a meta level, in case people don't know what we're talking about here. Carolyn, what's Quantopian?
Oh, sure, yeah. So Quantopian started as a platform where we allow anyone in the world to try being a quant at home. So what that means is they can write algorithms, use data, do research on the platform, and then we have a backtester. So we have an open source backtester, and then people can do that work on the platform. Over time, we found we had hundreds of thousands of people on the platform, and the result was we said we can use some of these algorithms in investment management business. And so we've since launched that, and that is kind of the two parts of our business today.
Adil, what's Move37?
So Move37 was started a year ago to take advantage of what we call discovering autonomous learning investment strategies. And you know, the bottom line is that there's a huge influx of data in the universe right now that's growing at some incredible rate that you've heard about today. There's data scientists that we're all talking about and surrounded by, and they're being produced all the time. There's also machine learning that we talked about, and cheap computing that is now available in the cloud that wasn't available before.
Right. This big confluence of things, right?
Big confluence of things. It's not just one thing, it's that confluence. And what that allows is new investment paradigms and strategies. And we're going out and finding small teams that do it and investing it with them.
And what's interesting about that is that you came from Protégé Partners, right? And which, and this is sort of the new arm of Protégé Partners. So you've had a foot in the old world, and this is the new one, right? So what excites you most about this confluence of factors that we're talking about?
Well, the old traditional investment management world was full of sort of human-only insights and kind of full of, in reality, old stodgy people. And this new world is what hedge funds were like 30 years ago. They're full of 25 to 35-year-old kids. They're coming up with a completely different point of view. They're not from business schools. You know, they're coders, they're hackers. They're coming up with a completely new way of doing things. And so you sit with these people and you get a sense of excitement that you just don't get from somebody who can just do stuff on spreadsheets.
Yeah. And Carolyn, for you, what you came up, actually, you were at Goldman for a while, and Quantopian's relatively new. What's the spark for you?
Oh, absolutely. Well, so it's many of the things that Adil just said, but on top of that, you know, the idea that we're accessing people all over the world. So these are people who are not local and easy to find, but they really come to us. And so what we've done to kind of really encourage that is we've established a whole education platform on the software that we have.
Right.
And so what's really exciting is people can come and bring their perspectives as data scientists, as physicists, whatever it might be, and really engage with finance.
And how big of a community have you guys put together?
Oh, absolutely, yeah. So we're at 160,000 people now. And so that, for me, you know, I joined the company about 6 months ago, and that absolutely was a driver for it.
And how much has that grown?
Oh, yeah, so we're roughly doubling every single year.
So not unlike data, I guess.
Sorry?
Not unlike the explosion of data,
Not
right?
unlike the explosion of data, yeah. Which, and by the way, that is part of what is so exciting for us is, you know, you hear IBM quoted everywhere that all, you know, 90% of all data was created in the last 2 years. So that implies, you know, over 200% growth every year. And so we need, you know, all these people all around the world working on that to really find interesting signal and value in the data.
Well, and that gets us to the rise of the AI investor, I guess, which is you could have never, you know, sat down with a computer and done this on your own. You sort of need to surround yourself with an exoskeleton, right? And that's kind of where AI comes in.
Yeah, and you know, it's not just AI by itself. It's very important to know that it's a confluence of things, right? Because 3, 4, even 5 years ago, none of this was possible. And I like to use the example of Uber, right? Which is, you know, when GPS came out, you know, taxi drivers were thrilled. They could use it and do all kinds of beautiful things, and they didn't have to know the roads anymore, right? So GPS by itself was very helpful to them. But then you had rating systems, you had a smartphone, and you had a bunch of unemployed drivers, and somebody put all those things together, and it came up with a business model that basically took a taxi medallion price from, you know, a couple $1 million in New York City to 100,000. So you know, it's a combination of events that does it. And in the investment active management paradigm, we think this combination of data science, machine learning, and cheap computing allows things to come about that's going to totally change active management.
So part of this is, though, there's all this unstructured data, right? And it's just fire hoses of data and more of it.
Yeah.
How do you wrestle with that, and how do you know when you find something special?
Yeah. So it's actually interesting you mentioned that. This is near and dear to my heart. One of the things that we're working on now is being able to turn that exact problem to this community of 160,000 analytical people. So one of the hardest things is, to your point, there's all this unstructured data. There's even structured data. It's very hard to use these things because a lot of the real insight comes from combining across data sets. So to use satellite data as well as earnings information at the same time, very challenging. So what we're actually working on right now is an API that will allow our community to actually wrestle with that themselves. So one of the really interesting things is all over the world, people are coming up with new machine learning, AI processes that are tools. And so every day there's 3 new interesting ways to work with data. And we're really trying to harness that from the community. So to your point, it's a fire hose. And for that reason, we need the scale of people looking at it.
What's interesting here, though, is that you guys are using a gigantic community,
Absolutely.
and Move 37 is actually betting on smaller teams.
That's right.
Right? So Adil,
Right, I mean,
what's the advantage there?
I mean, the unstructured, non-financial, and structured, huge amounts of data coming out. The problem there is that you can't do it in a spreadsheet. There's
right.
the old ways of analyzing it doesn't work anymore. You can't even look at it. You can't even store it in one computer. It has to be stored in multiple places and accessed in kind of different ways. Those techniques were developed by the young scientists at Facebook, Google, the intelligence systems of the world. So, the people aren't coming from business schools. They aren't coming from existing funds. They're coming from these new places. So, the idea is who's going to be good at this? It's going to be this new generation of data scientists.
Yeah.
Right. So why
and the small teams?
Yeah,
I'll
the
just
small
tell you
team.
the small teams. This was not possible 8 years ago, because if you were a couple PhDs starting out, or a couple of data scientists or whatever starting out and trying to do an investment strategy, you needed to have farms of computers, super cool computers. So you had to work for like Two Sigma or Renaissance or something like that. It was impossible to think, even dream, that a small team could compete with these people. But now they can just plug into the cloud, and small teams can have as much computing power as any large organization. And so the barriers of entry have come down. And so that's why we're finding these small teams now that we just couldn't find 4 years ago.
So describe what some of these teams sort of look like. How big of a community have you sort of sifted through?
Well, we started this process, take it 3 years ago, really, really seriously. We saw this TED Talk by Jeremy Howard, believe it or not. Everyone should see this Jeremy Howard TED Talk, which is really beautiful, and it kind of shows you how the performance of human beings versus machines is intersecting, and machines are starting to be able to do stuff that humans just couldn't, only humans could do before, right? And so we interviewed and sat down with over 200 teams of people who claimed or were using machine learning and big data and AI to be doing investing. And a lot of them use it to just get a new source of data, but then apply it to traditional long-short equity where a human is making the decisions. And that's not as interesting, right? I mean, what we're looking for, and maybe this is a quick way to like, what are we looking for? And when I say this machine learning, autonomous learning investment strategy, what is that different from before, right? It's the old type of quantitative investing was a human hypothesis-generated investing, right? Human beings came up, okay, so there's a value anomaly or momentum works, and they say, okay, let's test it on a bunch of data. They test it, it works. Then they automate it, they systematize it, they deploy it around the world, and they have a nice quantitative investment
But
strategy.
effectively top down.
Effectively it was a hypothesis-driven thing, and everybody understands kind of why it exists. Now you take the idea of a sort of a machine learning in this context of autonomous learning investment strategies, and what it is that you set up an architecture. So there's a human being there. Be very sure there's always a human involved here. There's man-machine partnerships. But the man sets up the architecture of either the neural net or the Bayesian network or whatever it might be, and then the strategy comes up completely data-driven. It's you feed it data, inputs, outputs, whether it's reinforcement learning, whether it's some type of other type of unsupervised learning, it comes up with a pattern or price prediction mechanism, and that's different from what a human could have come up by themselves.
Which gets to sort of the name of the company Move 37, right? Which was
Right. Oh,
during
yeah,
an
let me-
AlphaGo game, right?
Yeah,
You-
that's actually so I should say that. So it was a bunch of coincidences, but really good ones. So so Move 37, the name of the company, was inspired by kind of the seminal fights between man and machine in the world of gaming. So just a year and a half ago, the AlphaGo machine that was built by 9 PhDs at University College London. They started a small company called DeepMind. It was bought by Google for $500 million before they had anything, right? And so they went to work for Google, and they said, what should we
said,
do?
why don't you make a game?
Why don't you beat the world's best Go player? And the world's best Go player was Lee Sedol. And so, they had this game. Lee Sedol played against the computer in a large football stadium in Korea. It was televised. More than 60 million people saw this game. There were commentators, during it and everything else. And, during the second game, one of the pivotal moves, the computer made a move that was really weird. Like, nobody understood it. The commentator said,
Which was the
machine is
37th
broken.
move.
You're stealing my punchline.
Oh, sorry. But
But I have another punchline. So that was the 37th move when AlphaGo beat Lee Sedol and it totally confused him. Go back 20 years when IBM built Deep Blue to play against Garry Kasparov, and Kasparov said that he was never going to be beaten by a computer, blah, blah, blah. Now, the old computer that they did, Deep Blue, was sort of an expert system. It wasn't, it was AI, but different from AlphaGo. The Deep Blue computer, once they programmed it and everything, they gave it a lot of equations. They gave it different moves of the possible moves from a particular position in the board, a lot of memory, a lot of CPUs, and it beat Garry Kasparov, right? One of the pivotal moves was the 37th move as well, right?
How about that?
That's right.
Oh, it's just hanging out in the ether for you to plug.
I know. And then we did MOV instead of MOVE because MOV in machine languages, as you guys know, has replaced the old with the new.
So I guess one of the incentives to working with Move 37 is you get to listen to a deal talk. But when you think about the community that you guys have built at Quantopian, what is the incentive to participate in this?
Absolutely. Yeah, so there's a variety of them. What's fascinating to me is an enormous number of people, tens of thousands of people came to the platform before we ever launched an asset management business. So the only incentive at that point in time was education, learning how to interact with data for financial purposes. Also interacting with each other, so these very vibrant forums, people talk to each other, there's a reputation element that comes out of that. So people are really proud to share the things they're learning or figuring out or new ideas and then work together essentially, but virtually. And then on top of that, we do invest in certain algorithms. So what we now do is we license the IP, which is the algorithm written by the author. It's still owned by the author. And then we invest in those algorithms and they get 10% of the performance on that algorithm.
And how many algorithms have you guys tested?
So we've tested about 8 million. We've looked at about 8 million simulations. Again, it's a lot. So for us, that means that the investment process itself needs to itself be software that we can then have a hypothesis on and test and improve. But what that also means is that it's really hard to write a great algorithm. We've only invested in a couple dozen. And what's really interesting is people are coming to work on this incredibly hard problem. I mean, generating alpha without any exposure to all sorts of risks is really one of the hardest things to do. And people are excited to work on that. What we're also doing is by creating this data initiative I mentioned earlier, we're saying, okay, one of the hardest things also is to wrangle data into a usable form, but that's in some sense a much more constrained problem. So we've found, the CEO is an engineer, John Fawcett, he's an engineer, and I'm sort of a quant by background, and we always joke that I love the alpha generation challenge and he loves the data management challenge because one is sort of open-ended and the other is kind of much more constrained.
Yeah. So the fact that you guys have only invested in a couple dozen?
That's right, yeah.
Isn't that dissimilar from Move 37? Because I know that you guys haven't invested in that many as well, right? So talk to me about how you found those.
Yeah, so once you went through the 200 teams, the problem was a lot of them were finding old alphas, right? I mean, you put a machine to work on market data and it finds momentum, it finds value, it finds all the old anomalies that we already know about. That's not as interesting, right? So that's the first thing. Secondly, a lot of them are from purely academic backgrounds, and it takes a long time to modify these codes that you can download, like Bruno was talking about the Scikit and all that. Yep. The reason why all that's on Bloomberg is that it doesn't actually make money immediately, right? It takes years of R&D to get it place where you can actually predict prices in a reasonable way to make money in a way that's different from already known. So in the end, we found 6 that we've invested with, and then maybe there's another 6 on the short list that are possible out of the 200 plus.
And of those 6, can you kind of describe how they approach the investing world?
Differently, right? And so, and that's one of the key things. I mean, you can't diversify a portfolio of machine learning type people by geography or sector or asset class or anything else. So what we do it is by data, right? And we talk about the 4 quadrants data, structured, unstructured, financial, non-financial data. So first of all, the team should be using different sources of data, and then
And we're talking about across the teams, right?
Yeah, across all the teams.
Otherwise, you don't have a diversified portfolio
exactly,
as an
right.
investor.
So you don't want 2 managers in your portfolio that are using S&P 500 price data and using a genetic algorithm to come up with a price prediction, because in the end, they'll be finding the same thing. So you want somebody's using unstructured data from somewhere, somebody's using a neural net to come up with alphas. You know, they have different time frequencies. None of this is, by the way, none of this is high frequency trading. So there's some notion that HFT or high frequency trading is all this big technology. That's really just small time liquidity intermediation in the market. That's not interesting to us. All the strategies that we're interested in are sort of 100 to 200% gross exposure, very liquid. The time frames are days, weeks, months, not microseconds, right? So it's sustainable alphas that you don't have to lever 1,000 times to get the actual return stream.
Right. You said returns. What's that look like in this space? How much alpha is waiting to get tapped?
Well, the lowest that we'll settle for, I mean, the sort of bar is sort of a 10% net rate of return with no beta, alpha, anything like that. I mean, there's some that are doing 25% with a better than 1 Sharpe. And a lot of them are, at the moment, unconstrained in the sense that they're running $20 to $100 million. They could be running several $billion. It's a very scalable type idea in some sense. And you know, it's not going to get crowded very soon, in our opinion, because look at the data. The data is growing at better than Moore's Law. In fact, Moore's Law was the old way. I think it's now the best studies show it's doubling every 6 months.
Yeah.
So as long as there are new sources of data that by definition have not been analyzed or used creatively to predict markets, there's stuff to do. I mean, if that stops, then it's a different story. But we're in the first inning of this whole process.
So, and for you guys, when you're looking at what works, like how good is this for what you're seeing with the ones that you're investing in?
Yeah, absolutely. So one of the things is we actually we love to give our tools out for free to the community. That's sort of one of the reasons people come to the platform. And just this week, we released a new multi-factor risk model to the community for free to use. And what we're trying to do is enhance the community's understanding of exposure to these common risk factors that Adil was just mentioning, and really seek the pure alpha. And so we're educating on that. We also think this is the first inning, that the sources of alpha are really endless with this rate of growth. And one of the things we think about, you mentioned, people work on these things. There's R&D for years. One of the things we really look for is for people to bring from their R&D lives, so PhDs in a lab, for example, these new ideas that they can then say, I can actually translate this into an interesting algorithm. And so that's really where we look for the alpha, is in those unique perspectives.
And how worried are you about some of these things becoming played out, or other people, their community figuring out something that you guys figured out, and like it gets crowded, right? How much do you guys worry about about that space, and so many people are suddenly so fascinated on all this?
My view is you have to view alpha decay as a fact of life. So over time, alpha will decay. So the important thing is to constantly be on the bleeding edge of finding the next source of alpha and doing that at scale. And so, I don't know if we agree or disagree on that, but I do think that is something that if you assume you'll never have decay, then you're really asking for trouble. And the better thing is to be assuming you'll have decay over some number of years, and then really be constantly finding the newest source.
And look, that goes back to my point of the data growing, doubling every 6 months. That has not been analyzed. So, and as long as it keeps growing, there's going to be more stuff to do. And look, we've spent time with these 200 teams. We've chosen 6. We can't even classify the 6 teams into anything other than 6 different buckets, right? So no 2 are doing the same thing, and in fact, there's nobody else to compare it with. So yeah, it's going to get crowded sometime. But it's going to have to come from various different spots and people learning a lot. I mean, look, the first iteration of a PhD going into finance is they'll look at price data, and for example, shorts. They'll look at shorts. They'll come up with a great strategy based on prices on a short portfolio. And guess what? They didn't have good data on the short borrow going back through time. So of course, their short portfolio performs very well without the borrow costs in there. It's all the hard-to-borrow stocks. So you can put any machine learning algorithm into the markets, and the portfolio it will create as the best short portfolio is the hard-to-borrow shorts. You execute them, you make no money because you've paid it out on the short side. There's tons of pitfalls like that that they have to get over. So yeah, let them start working on it, and it's going to be a long time before a lot of people figure it out.
So let's stay on that theme of pitfalls for a second, which is, what are the due diligence obligations as an investor that the wider world might not know about because of the space being what it is?
I mean, one of the things that is sort of first principles here is making sure you've tested things in and out of sample. So there's sort of the statistical way of just saying, look at what you expect to happen based on the information you already know, then wait a little while and see what then happens subsequently. So it's essentially making sure.
But you want money in it while it's doing that?
Well, right. So you want to wait a little while. You have to, and then you have to balance that with this alpha decay challenge. So you want to not wait forever. So you need to figure out some reasonable amount of time. And so you want to be thoughtful about that as an external investor into a quant fund. You want to ask how people think about that, because that is a really challenging and important step. But then just understanding if there is any hypothesis or if this is a black box and you'll be able to explain or not explain what happens in the future, just as a first principle of knowing what you can expect from the investment.
Right.
So the out of sample thing, I'll just back her up on that sort of big time, is that you just cannot invest in any of these machine learning algorithms based on any type of hypothetical or paper track record, because old type investing, you can do it, but there's so many parameters in any of these techniques that you can fit any past data with any sort of efficacy that you want, and it'll be fantastic, right? Because there are enough parameters. So you have to then do all the out of sample tests on historical data. Then you end up simulating markets and make sure your machine learns on the simulated markets in conditions that it hasn't seen before, and it still performs. And then you put it to work in the real world with real dollars and let it go for a while until you have enough data to prove that your slippage costs, your transaction costs, everything was right. Only then and only then do you invest in them, right?
So closing thought, what are people not talking about enough in this space?
I think how hard it is to work with the data. So we talk about how much data there is and how many tools we have to work with it, but what we rarely talk about is that using those tools on those enormous sets of data is itself a very hard challenge. And so there's enormous amounts of effort that need to go into putting the data into a usable format that then creates kind of interesting future algorithms.
I think the whole active investment community is blind right now to something that's just going to take over their world. I mean, it's done it in retail. Google's done it to Madison Avenue. I mean, Mad Men is not making the ad revenues, right? It's some engineers or some ad word somewhere. And active management in the financial industry has been immune to it. It is here, and it's happening already. I mean, machines can learn how to do this stuff better than us. And the idea is to be partners with them, right? Men, women, they can think deep and make huge connections that are not possible without some domain expertise. You take the domain expertise and you take the wide breadth of a machine with all the short-term memory and all the calculation problem, and then you have the cyborg world. That's where it's going. So I think everyone is not just ignoring that right now in the finance world.
Right. Adil, thank you. Move 37. Carolyn, Quantopian. Let's give them a round of applause. Thank you.